Okay, so let's begin. Hello and welcome again to the Ducker Frontier webinar on Western Europe's 2021 Outlook. I'm Mark McNamee, the Director for Europe. Before we get started, we realize that some of you, of course, may be new to Ducker Frontier, so we'll just take one quick minute to provide you with a very quick overview of our firm and how we work with executives at major multinationals. As you can see here on the next slide, I'm not sure if it's moving or not. There we go. Ducker Frontier, okay, good. Sorry for the technical glitch there. Ducker Frontier is a leading market intelligence and consulting firm that provides tailored solutions to drive growth for clients across the consumer, B2B, healthcare, and tech sectors. Our dedicated team serve as advisors to clients, delivering the market and industry knowledge they need to succeed at all points in the business cycle. You can see who our trusted partners are on the following slide here. Obviously, a sort of wide range of logos that you can see across numerous sectors. So with the continuous research and insights, the custom solutions that we have, the analytical support services, we provide a number of our clients, which you can see here, with actionable and timely insights to adapt and win in their changing markets. Our company is headquartered in Washington, D.C., with offices in Troy, Michigan, New York, London, Paris, Berlin, Singapore, Shanghai, and Bangalore. For more information, please, of course, visit www.duckerfrontier.com. And I'd like to also show on the following slide a recent addition that we've included for our offering, which is our Frontier View mobile app. So I'd encourage all of you to please download our mobile app so you can quickly and easily view and download all of our content from the convenience of your phone. So with all that said, and having briefly introduced our company, I'd like to start the webinar by briefly introducing our panelists today, which includes me, of course. So many of you on the line here know me, Mark McNamee. I lead the research team for Europe here at Ducker Frontier, and we'll be sharing in this webinar insights from the more global and regional perspective. Our second panelist is Athanasia Kokinoyeni, who is our senior analyst for Western Europe, and many of you have worked closely with as well. And she'll be explaining in more depth how the region will be seeing varying rates of recovery out of the coronavirus shock and lockdowns. As Athanasia and I are in constant contact with our clients, of course, we'll be discussing not only the results of our research, but also what we've been hearing from multinationals on the ground and how they've been impacted by the coronavirus lockdowns and plans for recovery. If there are any insights you see today as part of this discussion or any questions that we don't unfortunately get to answer by the end of the webinar, our client services team, of course, will be happy to follow up with you directly. So with that said, looking at the agenda, our webinar today will consist of a 50-minute presentation followed by Q&A at the end. I will walk through our view on the global and regional economic outlook and how it impacts our expectations for Western Europe in 2021. After that, Athanasia will then walk through our view at a more granular level with a focus on our recovery index, in which we have assessed the strength of the recoveries for the primary markets in Western Europe. This will then, of course, be followed by an evaluation of industry trends at a more sectoral level, as well as our outlook for Brexit. We'll then round out the session with a Q&A session. So let's begin. So looking at the region as a whole, just to define terms, we will be focusing on Western Europe. So just to be sure, we will not be talking in today's webinar on Poland and Central European countries or Russia CIS markets. That webinar will actually be taking place in a week from today at the same time, so next Wednesday. So I would encourage any of you, if you're interested in those markets, to be ready for that. And the markets as shown will be that we're focusing on today will be your primary Western European markets, mostly Eurozone countries. So starting off from the global perspective, of course, everything has been completely transformed by the coronavirus pandemic. So what we're talking about today is how we're coming out of this. First things first is what we sort of expect or do not expect to be coming in the next several months as it relates to the coronavirus impact on these markets. So first and foremost, COVID will not be disappearing on its own. unlike what some officials, not just Donald Trump, have actually made statements on around the world. As far as multiple strains, or for example, beliefs also that the virus would weaken in the summer with hotter weather, some of these issues actually have not come to fruition. So multiple strains have been developing, but this has not actually fundamentally altered our assumptions, and it has actually encouraged markets to interpret this relatively positively, as multiple strains actually potentially diminish the virility of the virus. And also more globally, so you can open up all of these check marks here. In terms of secondary outbreaks, in terms of a vaccine, our fundamental assumptions actually remain the same. Please go back to the previous slide. Our fundamental assumptions remain the same as they had been really for the last 3 or so months. We expect mass vaccine production and distribution only having an impact really in the second half of next year. So that'll be taking place over the course of the beginning of next year, with more global immunity towards the end of next year. So we'll still see social distancing measures, and as opposed to the major lockdowns we saw in Q2, what will happen is what we've already actually been seeing in many European markets, which is more targeted, tailored, ad hoc restrictions taking place in particular sectors or in particular regions of countries for temporary periods, which doesn't actually fundamentally upset the underlying growth trajectory of most of these markets. And that's how we anticipate most of these markets will be dealing with the epidemic for the next 12 months or so. Moving on, beyond sort of the COVID impact, what we see here for 2021 is actually somewhat of an extension of the concerns and the risks that came to fruition in Q2 of 2020 and linger with us today, of course. The issue here is that a lot of the issues that arose in Q2 2020 will continue to linger throughout 2021 for most of the markets that we'll be discussing today. So weak demand impacting business output as well as investment, causing, of course, lingering unemployment, wage cuts, all that weighing on confidence, and the government unfortunately can't continue to provide such strong stimulus into next year and later, particularly as debts come due. So all of that, of course, weighs on growth prospects and recovery for next year. Now, I don't mean to sound too pessimistic, because we will see a recovery across all these markets to varying degrees, but there will be lingering impacts, unfortunately, for the next 18 months and even 24 months, to be perfectly fair. And a part of that is will be some of the longer term political and social impacts as well. So moving on to the following slide, looking at a global level again. As you can see from the chart here, the goal is sort of to get back to the pre-crisis 2019 demand levels. As you can see, Asia Pacific, led by China's recovery, of course, is leading the charge. They also, of course, dealt with the coronavirus earlier, so this makes sense. That said, a little piece of optimism here is that we have actually revised up China's growth, both for this year and for next year, due to its slightly more solid recovery than expected the last couple of months. So that's very good news for global growth, global commodity prices, and just general global economic stability. If you look at what's highlighted here for Western Europe, unfortunately, even as Western Europe does in fact recover, and truly a little bit later than most markets, structural factors which have also restrained Western Europe's growth since the global financial crisis will return and continue to limit Western Europe's growth in this post-COVID recovery. So still solid growth naturally, and these are massive markets. So even just a couple percentage points growth is quite significant, but nonetheless not to the type of growth you're going to see elsewhere or even in North America for that matter. Moving on to the next slide. In terms of commodity prices, related to China's growth on the one hand, as well as its gradual recovery, oil prices have actually been far more resilient the last 3-4 months than initially anticipated. This also assisted by the continued compliance of the OPEC plus Russia output cut deal. So continued compliance there has actually boosted oil prices to raise and encourage us to raise our forecast for this year to 41, and also for next year closer to $50 a barrel. In the case of Europe, these are still, historically speaking, relatively low energy prices. So this shouldn't have a significant impact on inflation or significantly erode purchasing power, which is of course the good news. Nor should it raise costs for businesses that significantly that it would tangibly impact demand. And beyond that, of course, in terms of U.S. elections around the corner here, the impact it has on Europe could be quite significant. Obviously, in the case of a Biden presidency, there are indications that his team would remove some, potentially all over time, but some of the tariffs gradually. And then also in the case, unfortunately, in the case of Donald Trump, there would be a notable impact insofar as retaining the current tariffs and very likely increasing them over time. So for Europe, it would be a net boon if Biden were to win, as this would improve the trade terms. The points I want to make here is that we have actually, since April, we have reversed our forecast for a Biden victory as opposed to a Trump victory. This is based upon the polling that you can see here, which is still shown at the national level. This is not electoral college, of course, but the national level, still Biden maintaining a solid lead. There are questions around this, of course. Many people talk about, of course, the electoral college, and more specifically, who can win in Florida, where the polling is very close. Biden has had a slim lead for months, but then also the amount of undecideds. If you look at the bottom chart, this is also what further confirms our belief that Joe Biden will win, is the fact that unlike in 2016, when Trump made a major comeback against Hillary Clinton and defied the polls, in 2016, there were a lot more undecideds after the Republican and Democratic national conventions. In this environment in 2020, there are far fewer undecideds, and therefore there's a far sort of fewer of these as we say, the silent majority in the United States of those votes to win this time around, making it a little bit more difficult for Trump to make up this difference and win the electoral college. Again, this more confirms our view that we do believe slightly in a Biden victory over Trump victory in November. But of course, a lot of time between now and then. The impact on Europe, though, would be significant. So please, of course, I'm sure you'll be paying attention to this. Related to the currencies then at a sort of a higher level here, as you can see, under our base case assumptions, of course. So we're not talking about, in the case of the pound, a no deal scenario. And of course, in the case of the euro, we're not foreseeing in our base case situation another sort of wave of major lockdowns that seriously deters growth. In this case of our base case, we do see both the euro and the pound slightly appreciating next year in year-on-year average annual terms. So that on average in 2021, both the euro and the pound should be, as you can see, a bit stronger against the dollar than they were in 2020. That said, this also means a little bit weaker levels than where they are currently as of this week, where the euro and the pound are actually quite strong and have been very strong for about the last month and a half against the dollar, which has occurred mostly due to the United States inability to extend that fiscal stimulus during the month of August, and are still having trouble extending that as we speak. So that has caused some of the strength. Beware, of course, of the U.S. elections that could cause further U.S. dollar weakness, and of course, beware Brexit and potential for no deal, which has risen. And so in Q4, seeing some pound weakness. So that could cause some variance from our current forecast for both the pound and the euro. So all of that said, moving on to the rest of the agenda here, I'm going to hand it over to Athanasia, who will then go into more depth here on Western Europe trends specifically, as well as our recovery index and Brexit at the end. So off to you, Athanasia.
Thank you very much, Mark, for the introduction and for setting the global context for the Western European recovery outlook for 2021. I would like to kickstart today's discussion with this polling question. Please feel free to join and participate. I would like to ask your view on what is your primary way of increasing profitability in 2021. 5 options for you. First, increasing sales volumes. Second, pursuing price increases. Third, reducing operational costs. Fourth, focusing on high margin customer products and segments, and last, other. I assume no, it's the inverse of those. So first, focusing on high margin, second, reducing operational costs, third, pursuing price increases, fourth, increasing sales volumes, and the last, other. I leave some seconds in order to share your view on this, and then we will discuss together the results from this live poll. We do have the results now. Thank you very much for the participation. We see that the top strategy in order for you to increase profitability in 2021 among the participants is the first choice, so focusing on high margin customer products and segments. It makes sense. This is something we are hearing across the client base, all the client base we are working on, and of course the disruption in the external environment makes market segmentation even more necessary than before. Of course, this strategy is combined with other strategies like reducing operational costs, which is the second option that is most chosen. And of course, those two together, those strategies together, will help improve your margins in 2021 and improve your profitability as well. Moving now to our expectations for growth overall. So this market segmentation strategy that you are following, you are very well doing so, and it makes sense because it's true that the external environment has completely changed from what we were expecting back in 2019, when we were seeing an increase in growth. We were expecting an increase in growth in 2020 overall, and an upswing in manufacturing. This, of course, momentum is severely disrupted by the COVID crisis, and now we are expecting a recession of at around 6% for the Western Europe average. Of course, with variations among countries, the range varies from -4 to 7.5, -7.3 for South European countries in particular. You are seeing that countries that are more industrialized, like Germany and the Netherlands, are less bruised by the COVID situation compared, it's all relative, right? And when you compare it with Greece, Italy, and Spain, the very tourism and service-based economies, it makes sense why those South European countries will suffer most of the contraction related to COVID. What about 2021? We have only a moderate expectation for recovery in 2021. We think it's unlikely the region will fully return to pre-COVID levels in 2021. We'll put this in context more around 2023, late 2023, where we think that the average for the region will return to pre-COVID levels. But overall, as I mentioned, there will be more growth, stronger growth in 2021, and it will be followed by even stronger, even more robust growth in 2022. So we think that the strong year for the recovery will be mostly 2022 and not 2021, as many of the other agencies consider out there. Three main assumptions I would like to share with you that we base our forecast on. First is that we don't expect a return to normality before H1 2021. We think that the outbreak will be continued, so we are not going through a second or third wave. This outbreak will be continued, but we will continue to see increased testing from Western European governments, but also strict social distancing measures. But but it's unlikely that we will see a big death toll because of the virus in Western Europe. So overall, the outbreak will be continued, but it will be relatively contained. Second big assumption for our forecasts, we do not expect nationwide lockdowns again. This will be last resort measures for Western Europe. Currently, the line of the European Commission is that the economic activity is maintained, and that the fiscal reserves cannot sustain another nationwide lockdown. So that this is why we do not think in the second half of 2020 we will have such a steep recession as we saw in the first half. But also this is the reason why we expect a return to growth on year-on-year terms in 2021 and not a recession. A third main assumption to our forecast is, of course, Brexit. We do not factor in no-deal Brexit in our growth assumptions, and this is why you see growth of 2.3% for the UK market in 2021. But of course, if in the absence of Brexit, you would see a rate of up to maybe 3 or 3.5% for the UK. So of course, Brexit is holding back the recovery. A better visualization of the pace of recovery, which is multi-speed, as I mentioned, among countries, is with our quarterly forecasts that are available for Western Europe 5 largest markets. You see there clearly that the UK and Spain, unfortunately, suffered the most in the first half of the year, but we expect more, let's say, of fast-paced recovery in the second half of the year, especially for Germany and for the UK only for Q3. Unfortunately, in Q4, we will see a further decline of economic activity compared to Q3, and this is because of the rising risks of Brexit. We will spend more time towards the end of our webinar around Brexit and our assumptions behind this. Likewise, when you are experiencing as well a very weak external environment, this is translated in generally subdued inflation. So inflation overall will not fluctuate much. We will see deflation in some countries on a year average, especially in Spain. The Spanish market is more dependent to energy, so the fact that we have weak oil prices will keep this market in deflation in 2020, and we don't expect any big surge in inflation either in 2021. What keeps inflation more moderate? This is in line with what Mark shared. The appreciation that we are seeing of the euro to the dollar lately, but also has to do with the weak oil price environment that is, of course, suppressing inflation numbers. When we are looking at the pace of the recovery, you can look at it in two ways. The first is the short-term pace of the recovery, that we are assessing it through the index that I will show you later on. And the second way to approach it is by the full rebound to pre-COVID levels. When we are looking at the long-term recovery now, we are seeing that markets like Greece there will be the first to recover in 2023, but of course Greece is a small market and it comes from a low base. So when we are looking for the opportunity in a large market, this would definitely be Germany. So keep in mind that Germany will be clearly a business opportunity going forwards, because it was the market that was not as bruised, not as suffered, not as much from the COVID crisis, but also it had a better, the German government managed better the outbreak. And of course, you have seen there a very strong fiscal stimulus. We will spend more time about the factors that play an important role on the pace of the recovery for each market in the index that I will share with you right now. So in order to assess the pace of the recovery, as I mentioned, it's a multi-speed recovery, and there are many, many different factors that play a role. We created the pace of recovery index in the Europe team. You will find more information about it in our Europe recovery report. You can find in Frontier View. And in terms of what we looked in terms of the factors that play a role in the recovery, that determine the recovery, we broke this down into two categories: the epidemiological profile and the economic profile. In the epidemiological profile, what we're looking at is number of cases, of course, death toll, also testing capacity, but also lockdown strictness and the length of the lockdown. And the economic profile, we're looking at various economic metrics, with the most important one being fiscal support. And when I speak about fiscal support, is the direct measures that play an important role, like employment support, like tax deferrals, like lump sum support amounts, those type of things, but also other things that play a role is nature of the economy. Whether it's more tourism-based economy will suffer more from COVID compared to a more manufacturing economy, but also number of SMEs, public employment, and other cultural factors. In the next slide, I show you how the back end of this index looks like. We do have the index, this breakdown of the index for most European countries. You will spend more time on CE countries in the next webinar, but for this webinar, you can see here Western European markets. You can see as columns the 10 factors that we highlighted as most important in order to assess the pace of the recovery for those markets. You saw them before, as I highlighted before. When we aggregate all this exposure by category, as I mentioned, 10 factors that play a role, we end up with the total exposure to COVID. When we want to put in a bucket the countries that face a low exposure to COVID, moderate and high, we can do it like that using the index. So for instance, we have identified that Denmark, Finland and Germany are markets that are not as exposed to COVID as markets like Austria, Belgium, Ireland. You see the ones that are more moderate here in yellow. The ones that definitely, the markets where we see a risk, definitely a risk, and a slower relatively recovery, when we try to isolate the COVID impact on the economy, those would be Greece, Italy, Portugal, Spain, and France is really on the borderline between moderate exposure and high exposure. In terms of the time frame that we see the whole region returning back to pre-COVID levels, as I mentioned, this will not happen before 2023. And for some markets, for instance, like the UK and for Italy, this will happen in late 2023 for different reasons in every market. Let's try to understand and delve a bit deeper what is most important for each market's recovery. Let's start with Germany. As I mentioned, is clearly an opportunity market. Why we think that there will not be such a steep recession seen in Germany compared to other markets. This is because the market is less exposed to tourism. As I mentioned, it's very important. We have seen a short and successful lockdown there and better management of the outbreak, but also the most important factor is that Germany has introduced the largest fiscal and monetary stimulus packages in Western Europe for sure, but maybe across EMEA. Moderate opportunity countries, we highlight particularly, as I mentioned, in the index, the UK among other Nordics countries, but let's focus on the UK now in the interest of time. So what we have seen is that H1 was a tough period for the UK, but the strong employment support, high public sector employment, but also a low exposure to tourism will help the market start to recover in Q3 of this year. However, Brexit will give another hit to the economy, and it will be on top of the COVID disruption. So 6.5 recession for the UK in 2020, and only a moderate pace of growth for 2021. What about the lower opportunity countries, where we identify most of the risk that those countries will return to pre-COVID levels last? Those definitely are markets that are more exposed to tourism. This is key for us to keep in mind, to note. And this is among all those countries that we mentioned in this slide. So France, Spain, Greece, and Italy. Of course, there are other factors that play a role. For France in particular, what played a damaging effect is the strict lockdown in combination with a low manufacturing component compared to the rest of the countries. And for Spain in particular, we have seen a downside in the last weeks. We have seen a considerable rise in new cases in this market. So it presents a negative epidemiological profile compared to the rest of the markets. Of course, for Italy, what is most importantly disrupting growth is the low fiscal stimulus. Regarding the fiscal stimulus now, what is most important, as I mentioned, is the direct fiscal stimulus. Of course, you might have seen like very different numbers out there about the scale and the level of fiscal stimulus by country. When we are identifying and isolating only the direct fiscal stimulus, because it's the part of the stimulus that has more of a beneficial effect to the economy faster. Those markets ranking first would be Austria, Germany, and the UK, followed by some Nordic countries, and then last, unfortunately, would be the countries that are more exposed to the virus through this high tourism component, like Greece, Italy, and Portugal. This, of course, this factor will not help much the low fiscal stimulus, those markets to recover faster. Let's move now to the industry performance, because it's different to evaluate the pace of the recovery on a geographical level and different to evaluate it on a sectoral level. For instance, in some markets, you might see a low recovery pace as a whole, but the food, for instance, and beverage sector, you could expect that it would recover faster than the overall country. So it makes sense to look at it from a sectoral perspective. What we highlight here in purple are actually the risk sectors. Risk sectors would remain to be throughout 2020 and 2021. Retail durables, particular, we have seen that the low consumer confidence has driven weak demand for big ticket purchases in particular. Manufacturing overall will remain subdued for the same period, but of course there are variations within manufacturing, like food manufacturing will perform better, and also manufacturing of pharmaceuticals. Construction, unfortunately, will continue to suffer because of the fall in investment and the fall of in investment confidence. Healthcare, particularly both pharma and medtech, would be opportunity sectors to look at in Western Europe. together with financial services, we are seeing some activity, so positive stock exchange performance since the beginning of the outbreak. And last, in terms of the opportunity segments, is of course the IT and telecom, very strong digital sales that we have experienced since the beginning of the outbreak. That of course supports the IT and telecom sectors. The sector to recover last, unfortunately, is a very important sector for Western Europe, and this is the hospitality, tourism, and leisure sectors here in the bottom of the table. We don't expect tourism levels to return to pre-COVID levels up to 2023, unfortunately. Looking a bit more into the different sector, we know that the lockdown has aided the consumption of food. In particular, we saw lots of stockpiling activity happening. However, going forward, we do expect a normalization of demand of this category. On an average, we will still see positive and solid performance, but not the double-digit growth that we used to see during the lockdown period. Of course, this should inform inventory assumption for those categories. In terms of the durable goods demand, as I mentioned, consumer confidence has been subdued, and that is what is keeping low purchases for vehicles, for instance, or for other big investments, household investments. Unfortunately, looking forward, we do not think that there will be a full rebound to consumer confidence in 2020. This means that durable categories or like big ticket purchases sales will remain weak throughout 2020. This is in line with what we are seeing in tourism volumes, particularly in markets that are more tourism focused, like Spain, like Greece, like Portugal. We are seeing much weaker demand for categories that are more dependent to tourism expenditure. This will unfortunately continue to be the case. We identify a 50% decline in tourism volumes overall in Western Europe in 2020, and a continued decline, unfortunately, in Q1 2021. We will see a return to growth back in the second half of 2021, unfortunately, for tourism, once there is mass vaccination. Once we expect that there will be mass vaccination of the population in Western Europe, if, of course, there is the discovery of the virus, of an effective virus, right? In terms of the effects of the virus, we have seen that there has been a complete change in consumer behavior due to the virus. And what we are seeing is that consumers are less reluctant to shop in physical stores. So there's a big shift of demand, not new demand, but a shift of demand to e-commerce sales in particular, mostly for non-grocery products. We are seeing that across Western Europe, in most of the markets, in all of the markets, there is reluctancy of consumers to shop to big malls, to big complexes, in fear of contracting the virus. So it makes sense to inform your strategy to be more local based, to enhance your local representation of your brand in order to improve your margins. In terms of travel, we have seen that countries like the UK will continue to travel abroad, but we are seeing that the Germans and the French will prefer, until there is mass vaccination, they will prefer to travel domestically. So this means that we expect a support of the economy overall, of the domestic economy, compared to international tourism. Retail confidence, what we are hearing from retailers, of course, a big hit from the COVID situation, especially during the lockdown. Looking forwards, you should anticipate tough price negotiations, because retail and consumer confidence will remain low and will not rebound to pre-COVID levels. And more often than not in Western Europe, especially in smaller markets that are that do not have the same infrastructure and financial infrastructure as well, you are seeing liquidity problems among distributors. So something to keep in mind. E-commerce sales is definitely the king compared to the pre-COVID situation. We have seen double-digit growth in most of Western European markets. And on top of the list, you can see there Spain, but also the UK. It's not included in the graph, but we have seen a very big surge also in the UK e-commerce sales. And this channel, the e-commerce channel, the digital channel, is the channel that has been the only healthy channel during the pandemic, and it makes sense that we're seeing big investment funneled to this channel across our client base. And we are seeing that companies are tapping into new customer segments. So customers that did not that were not familiar to shop online before now do so, like the older generation or other people that were not familiar with shopping online. And this means that e-commerce levels will remain strong. We do think that there will be a normalization going forward, so you won't see 40% increases in e-commerce sales. There will be some normalization, but overall, definitely an opportunity for positive growth there. And of course, this should inform your assumptions for your inventory levels and your supply chain capacity going forwards. I would like to invite you to another polling question now. The question would be, what percentage of your organization's forecasted total sales will come from e-commerce? And the choices are: first, more than 20%, second, between 15 to 20, third, between 10 to 15%, fourth, between 5 to 10%, and last, less than 5%. We would like to understand how much you have invested in e-commerce, and what returns you expect from e-commerce in 2021. Please share with me what you are seeing. I will leave a couple of seconds in order to populate the results, and we will discuss them together. The result is quite surprising, I would say, to me, because it's different from what we hear from our clients. It seems that most of the participants they expect only less than 5% of total sales coming from e-commerce. I would expect that this number would be a bit higher. The second response coming after this is more than 20%. I would expect that we would see around those levels, but of course it really depends on the category of goods, because in B2C goods it's much easier to facilitate an e-commerce strategy than maybe it's for the B2B segment. It has to do with the nature of the product as well, so there are lots of different factors that play a role in this.
Yeah, this is Mark. I'll just jump in here quickly in interpreting these results as well, and comparing this with other countries. This actually doesn't particularly surprise me in light of the fact that I would anticipate, based upon previous webinars, that's probably up to about maybe as much as 40% of attendees are B2B firms. So that being the case, that is going to probably drag that number down quite considerably. Whereas if we polled mostly the B2C companies or exclusively B2C companies, I think we would be seeing results almost assuredly above 10% for most all the responses. So this actually doesn't surprise me. Yeah.
Yeah, if we had the breakdown, it would be a better indication of a breakdown of sectors. It would be a better indication for this number. Moving forwards now, in terms of the performance we are seeing in manufacturing, which varies a lot from subsector to subsector. In a nutshell, what I want to show to you, of course, there's lots of information, but this is a very useful tool for you when you want to evaluate segment performance and do prioritization of segments. You're seeing very clearly that markets highlight that sectors highlighted in blue, like manufacture of food goods, of pharma products. Those would be the main categories where we saw most solid performance in Western Europe, and in terms of the red areas, the risk sectors, this would be manufacturing of textiles, where we saw underperformance in the first half of the year, in particular everything that has to do with processing oil and minerals, but also manufacture of motor vehicles, where we identify subdued demand because of the weak consumer and business confidence. I leave this to you to see it with your local teams, because you can have an idea of which of those manufacturing sub-segments have performed better in each market. Like in Denmark, you see that manufacturing of food products has done very well. But keep in mind that this is for the H1 performance. Although the trends should continue, they should relatively normalize. So you will not see such big contraction in turnover in manufacturing in motor vehicles, let's say, in the second half of 2020, of course. Now, Brexit, everyone's favorite topic. We will spend 5 minutes on this because I know it's a top concern for you. What we have seen lately is some developments coming from the UK front, but also from the EU front. Let's start with the timeline that should inform your expectations for contingency planning in particular. A big milestone event we expect is the next European Council meeting, where we will know more information about how the new relationship of the EU and the UK would look like. The last deadline, the very last deadline set in stone would be December 31st, of course. It's a legally binding deadline, the end of the transition period. So the meeting where we will see most of the decisions taking place for Brexit would be December 10th, although we might see the introduction of an emergency, as we call it, or an emergency meeting in the end of December about Brexit. So January 1st, 2021, at the end of the transition period, we do think that there will be an end of the transition period. We doubt that there will be another extension because it's a sensitive matter politically for the Conservative government. we think that Johnson will be reluctant to extend once again. And of course, we will know in the end of December whether we're heading for no deal or not. Currently, the base case is that we do not go for a no deal. We think that there will be a basic agreement on the basis of the FTA framework, so free trade agreement framework, but approaching the deadline in the end of September, you will see an aggressive narrative from both the UK and the EU. They will increase pressure to push on their demands for the other side to give in. This will be a negotiation tactic. But because of this, you should expect pound depreciation in the last quarter of the year, and some uncertainty, some increased uncertainty around new investments. So definitely investments will be hit because of this situation. No deal, as I mentioned, should not happen, is not part of our base case. But if it happens, you will see the effects of no deal, aka tariff and non-tariff barriers, being implemented in the second half of 2021 from the UK government. We know that the UK government has given a grace period to companies in order for them to adjust to the new trade relationship of the UK to the EU. So in other words, the UK will waive any tariffs in the first half of 2021. And if we see no deal, this will have an impact on trade in particular in the second half of the year. But if we see no deal happening, if we're approaching towards no deal, this will have a negative effect on sentiment much earlier than that, unfortunately. What has been holding back Brexit negotiations so far? Those are 6 important issues. Those are the sticking points. The first is the level playing field. This includes various different things, and the EU in a high level wants to ensure that the UK will not have an unfair advantage when participating in the single market compared to other countries like Norway, like Switzerland, where they have something a bit more tailored with the EU. Fisheries, another important sticking issues. The UK wants more fishing rights in EU waters. This is a big disagreement between them. The third sticking point is the ECJ jurisdiction. The UK wants to end the jurisdiction of the European Court of Justice and be able to change EU regulation as it currently occurs in the UK. But we think that this will take place in the medium term and not in the short term. Irish border, ongoing issue. We don't expect a resolution anytime soon. Financial services, something that will be decided much later on. Data exchange and security issues with that will be ongoing. All those sticking points are holding back agreements so far. We don't think that there will be a full agreement on those issues, but particularly for the level playing field and fisheries, there should be some basic agreement in order for the UK to avoid no deal. This is in everyone's interest, both for the UK and the EU, to avoid no deal, because EU as a whole will start to recover in 2021 from the COVID situation, and Brexit will not help at all economic activity to recover once again. And in terms of, you would be interested about our likelihoods, or if you're following the monitoring tool, the bubble tool as we call it. So we have recently updated the likelihoods of no deal Brexit. We have increased this likelihood from 15% to 30%. And this is in response to the latest aggressive comments of the Johnson administration about selecting some sections of the withdrawal agreement and defaulting on the rest. We think that this will not be something that the EU would allow. We see some clash coming from there because the UK wants to push as much as possible in order to earn more and to win more from this negotiation. Those are, of course, this is pure brinkmanship that we are seeing from the Johnson administration, but we need to keep in mind that there are perils associated with this strategy, and this could end up with a considerable pound depreciation in the last quarter of this year. Basic FTA deal 60%, so we're most confident about this scenario, and extension of negotiations only 10%. This is all I would like to share with you in terms of material. In case you have any questions, we will share this deck with you, and feel free to follow up with us. We can go now into the Q&A session. We can wait for a couple more questions, but there is one that I see.
Okay.
Yeah, there is one in Italy, Mark.
Yeah, so we already addressed that. There is a question statistically on the chart about Italy's inflation 2020, and we can confirm that yes, Italy's inflation is around 0 for this year. So there was also a couple other questions that had come through, and I also had a question for you to clarify for the audience. So in terms of there's a question that came in about no deal. You seem to address it regarding whether no deal is more likely now because of Boris Johnson's recent announcement, which you somewhat addressed. So it seems, just to reiterate, that we have indeed raised our likelihood for no deal up to 30%. We still do fundamentally interpret this as a negotiating tactic, at least at this point. But there's risk, of course, of pound depreciation, and obviously this just raises more concerns regarding hitting the timeline of the end of the year and passing things on. But I think it's important to note, since you already did address this, I think it's also important to note that we haven't seen the pound depreciate from that this week. So markets are actually kind of taking this in stride and seeing this more as noise music for the just more noise at the current period, as opposed to fundamentally changing the dynamics of the negotiation. So just to address that quick question, there's another question related to likelihood of a major second wave and lockdowns. It seems similar to what we have seen in Q1, or sorry, in Q2. I can actually answer that one quickly. Just in terms of our base case assumptions, we do not expect anything really near approaching what we saw in Q2, and that's due to the fact that we have learned much more about the virus, its nature, its nature of transmission, the demographics that are at risk, its mortality rate, or the fatality rate of the virus, et cetera, which was the fundamental impetus for doing all of these major lockdowns across the entire global economy in Q2 and in Q1 in Asia, because we needed time to identify and understand the virus and understand its nature better. And now that we do have a better grasp of its nature, there really won't be much of a need, except in an extraordinary downside, very unlikely situation. There would not be a need to implement such severe lockdowns and restrictions once again. So that's very unlikely to occur at any point in the next 12 months.
Maybe I address a couple of more questions, yeah?
Yes, I see some other questions have come in, so please go ahead.
So one question is, EU has spent big money on southern countries. You don't see or mention any positive impact. If you mean a positive impact on the economy, of course, in the absence of this stimulus that we have seen, you would see much steeper recessions in the countries of the south, in Italy, Greece, and Spain. You are seeing a 7% recession in 2020 because the decline in economic activity is supported, let's say, not supported, but aided in a way. There is less of a decline in economic activity because of the stimulus. So it's very important. Actually, in our index, we have weighted this factor as the most important related to the pace of the recovery. So it's very important that we've seen the fiscal stimulus in Southern Europe. However, when you compare fiscal stimulus in Southern Europe and in the rest of the markets, it's very low compared to what we're seeing in Germany, in Austria, in Switzerland. And this makes sense because the markets of the north have the fiscal leeway and the fiscal reserves to spend more than the indebted countries have. So it totally makes sense. Another question, what are the projections of normalization of e-commerce? Of course, as I mentioned, there will be normalization of e-commerce, but until the end of the pandemic, that will take some time, until at least 2022, we think that e-commerce sales will remain solid. Of course, the performance will really vary from product to product and market to market. And the last question, how do you see the new habits of hygiene standing? Will gel, sanitizers, etc. stay as a default or fade away as the pandemic disappears? We think that, first of all, when we move away from the pandemic, then this will be closer to the end of 2022, 2023. We do think that there will be a gradual return to the previous habits and to normality, as we call it. But it will be long until we see that. So until that point, we do think that the demand for hygiene-related products will remain solid, but we will not see sales increasing double-digit as they did during the lockdown. It was mainly the lockdown that was driving this stockpiling of hygiene-related products. That's all regarding the questions that we have received.
Great, thank you for handling those, Athanasia. So with that, I see we're a bit past time. So thank you to all the attendees for staying on and participating. We'll be sending along the slides that you've seen here to each of you who have attended. And of course, we're happy to take any further questions you may have offline. So that concludes our webinar for today.
Thank you very much.
Thank you again, and we look forward to speaking with you again soon.
Thank you very much.
Bye-bye.
Bye, everyone. Bye.